வாங்க ஒரு சிம்பிளான விஷயத்தை பார்க்கலாம்.
Let's jump right into this explainer. Today, we're decoding the invisible forces that secretly dictate pricing in the stock market, specifically the India VIX and implied volatility. If you've ever traded options and felt like the math was just rigged against you, well, this is exactly what you need to hear.
Let's start with a mystery I think we can all relate to. Picture this. The Nifty 50 is in an absolute bloodbath. It's crashing hard. So you step in and buy a put option to catch that aggressive downward momentum. Makes perfect sense, right? But then, something goes horribly wrong with the pricing. It's a terrifying but honestly incredibly common trap. You're looking at the option chain, and a strike price that normally costs you a reasonable 40 rupees is suddenly trading at a massive 140. The downward momentum is just so strong, and the panic is so palpable, that you let FOMO take the wheel. You chase the market and you buy it anyway at that massively inflated premium, hoping the crash continues.
And here is the agonizing result of that split-second decision. After you buy in, the market just stops. It stops crashing and goes completely sideways for an hour. Suddenly, your 140 rupee option tanks down to 80. Just like that, you've lost 40% of your capital. And the most frustrating part, the actual index barely even moved. So how on earth does a premium crash so violently when the market is literally standing still?
Well, to answer that, we need to look at what we call the expensive option trap. In that sideways market scenario, you didn't just lose a regular trade based on price action. Nope. You actually fell victim to two powerful intertwined forces working behind the scenes: implied volatility, or IV, and the India VIX. These two factors were actively manipulating your premiums without you even realizing it.
So what exactly is the India VIX?
Simply put, the volatility index isn't a stock. You can't just log into your brokerage account and buy or sell the VIX. Instead, think of it purely as a mathematical gauge. It's literally a thermometer for the entire stock market. It measures the aggregate amount of fear and the anticipated movement in the market over the next rolling 30 days. Just look at the two extreme ends of this thermometer. A low VIX, say dropping below 12, means the overall market is totally relaxed, complacent, and moving incredibly slowly, basically zero fear. But flip over to the other side. A high VIX, pushing above 20, that signals absolute institutional panic. When the VIX crosses 20, the big players are bracing for wild, violent swings in indices like the Nifty and Bank Nifty.
Let's break down the actual mechanics of that panic. Step 1. Big institutional players with massive portfolios get spooked. They fear a market crash is imminent. Step 2. To protect those giant portfolios, they rush to buy put options as a form of insurance. And Step 3, because every single institution wants that exact same insurance at the exact same time, that immense surge in demand causes the prices of those put options to absolutely skyrocket. They drive the prices up through a pricing mechanism we mentioned earlier, implied volatility.
This perfectly leads us into our next concept, the IV balloon effect.
Implied volatility is essentially the market's forecast of a likely movement in an index's price. If the VIX is the thermometer reading the level of fear in the room, IV is the actual engine acting on that fear. It's the core, defining component in the Black-Scholes pricing model that makes options either astronomically expensive or dirt cheap, completely independent of the actual stock price.
To really cement this concept, let's use a simple analogy. I want you to think of the premium of an option exactly like a balloon. Keep that visual firmly in your mind as we look at how this plays out in real time. Here's how that balloon works in practice during a panic. When the India VIX goes up, the fear thermometer is rising. That directly causes implied volatility to increase. Essentially, institutional fear pumps air directly into our imaginary balloon. As more and more air goes in, the option premium gets massive and incredibly expensive. That right there is exactly how that normal 40 rupee option aggressively inflated into the 140 rupee trap we saw at the very beginning of this explainer.
But here comes the ultimate danger to your portfolio. It's a phenomenon known as the IV crush. When the market eventually stops crashing and calms down, the VIX drops. Because the fear is gone, implied volatility decreases rapidly. The air is immediately let out of the balloon. If you bought that option when the balloon was fully inflated with panic, well, your premium physically shrinks, completely destroying your capital. And remember, this capital destruction happens even if the underlying index stays perfectly flat. The air just leaves the balloon.
Okay, so knowing all this, how do we actually trade the VIX?
During high VIX conditions, options are essentially fully inflated balloons. If you're an option buyer, you need to take immediate defensive action. Reduce your lot sizes heavily and stop buying far out of the money options, because those specific premiums are purely inflated by IV and carry massive risk of getting crushed. On the flip side, if you're an option seller, this is absolutely the best time to trade. It's the perfect environment to play the insurance company and sell those highly inflated balloons to panicked buyers right before they inevitably deflate.
Conversely, let's look at the strategy for when the VIX is low. When the fear thermometer drops below 12, all the air is out of the balloons. Option premiums are very cheap, which sounds fantastic for buyers, right? But there's a catch. A low VIX means the market is moving very slowly and complacently. Buyers have to patiently wait for a clean, explosive breakout to catch real momentum. If you just buy and hold in a slow market, time decay, also known as theta, will simply sit there and eat away your cheap premium while the market does a whole lot of nothing.
The ultimate takeaway here is this. Do not fight the India VIX. You simply cannot beat the underlying math of the market. Instead of fighting it, you've got to let it act as your definitive guide. You should be checking the VIX daily to determine your lot size, your strategy, and your overall risk management before you ever even think about clicking that buy button.
So, I'll leave you with this final thought. Now that you know the mathematical secret of the fear thermometer and the mechanics of the IV balloon, how are you going to approach your very next trade? Will you let the VIX guide your strategy, or will you let FOMO take over and fall right back into the expensive option trap? The choice and the capital is yours.
இந்த வீடியோ உங்களுக்கு பிடிச்சிருந்ததுன்னா லைக் பண்ணுங்க, ஷேர் பண்ணுங்க, சப்ஸ்கிரைப் பண்ணுங்க. Thank you for watching.